In this episode, Ryan and I discussed the conceptual origins of whole life insurance and how they make IBC so different from conventional financial strategies. And we had fun doing so. Hope you enjoy. Welcome to the Bank with Life podcast. I'm your host, James Neathery.
And I'm your co-host, Ryan Griggs.
Mr. Griggs, how have you been, sir?
I'm great. It's early October, so it's no longer 150 degrees out here in the DFW area. So I'm enjoying that.
Yeah?
Yeah.
Yeah, it's quite pleasant. So here, this is actually, it's mid-October. We're just a couple of weeks away from the October event. So this...
1 week.
1 week. This recording should be released on Friday the 20th.
Yeah. You want to share some updates about the expected attendance? I mean, it's going to be a full house, huh?
Yeah. I think, to my knowledge, there's 138 people registered. I think that includes, my office and a couple of agents. And so that would be over 100, well over 100 just clients.
Yeah. And I was telling you earlier before we went on that I still have a few of mine who have inquired about attending. So I think there'll be around 150 people in the room.
Yeah, well, Jess and I have a little wager going. I think 140, and she says 150.
Yeah, I'm excited. You and I were talking earlier this week about the talks that we're going to give and just overall plans for it. And you kind of, I don't know how we brought it up, but talking about like what exactly this is.
It went something like this. What are you going to talk about, James? If you put your talk together and like, no. If you put your talk together, no. That's how it kind of started.
No.
What are you going to talk about?
No, we've had several calls. We both had a pretty good idea of what the content will be, but no, it's like in thinking about what it is we're doing. I mean, it's not a conventional. It's not a sales event, right? It's not like here, sign up on your way out the door kind of deal. So it's not that. It's not like just a knowledge receiving event. We're not just teaching.
Entirely an educational event.
Yeah, not meant to be just knowledge transfer, right? Like sit there and soak it in. I mean, there's some of that. Maybe somebody learns something new or thinks about something in a different way. I mean, hope that's part of it. But it's not only that.
It's not a client reward, even though it's a client-only event. So there's an element of that they get to experience something that non-clients do not. But it's not only for an experience that no one else can experience.
Right. And then there's the social element. I mean, all those different people, beautiful venue.
A social event prior to the pre-mixer and then a social event after the after party.
Yeah. So there's elements of that too. I mean, so there's all these different characteristics that are coming together. I think it's going to be really cool. The last one was really good. This one, I think will be even better. So I'm excited for it. And I think it's very unusual. I don't think this venue, this kind of meeting is a thing that happens really otherwise. Other people may have some sort of event, but I mean, I don't know, this one seems unique to me, but I'm excited.
Me too. I think it absolutely is unique. Done a lot of events over the years and none of them have been identical. We would bring Nelson in and have him present over 1 day or 2 days. And of course he would, teach the same thing, becoming your own banker, just dang near right out of the book. But all the anecdotes and analogies, spread throughout there. He never said the same thing exactly twice. Mm-hmm. I've done lots of events and they've all been a little different. They've all been a little unique. And I'm really excited about this. I don't believe that the opportunity is ever going to present itself again to have all of the speakers in the room and even the guests. Let's say 80% of them or 100% of them come back the next year, but then there'll be other new people too.
Yeah, good combination.
Absolutely,
new people and returning.
Yeah, and so it's a little window of opportunity to participate in a very unique event that just doesn't happen that often. Yeah. It's never happened before. I don't mean to go on and on about it, but I'm just telling you the two guest speakers, they're just never going to be in the same room unless there's an agent training kind of a deal. I mean, they're never going to be in the same room where there's just, the all-American general public, the policyholders, the people that are practicing the infinite banking concept. There's
not gonna be another I don't think so.
I've never seen it happen.
Yeah.
I'm very blessed. I feel, thankful that I could entice them to participate.
And it's kind of a challenge to me too. I mean, you and I talked about like what the goals that we want to achieve. And I think that the same, what we talked about in that context also applies like for this show. Because to my mind, and I've told you before, I probably said it on here, like I have this fear of repeating myself and feeling generic or feeling like we're going over the same thing over and over again. And in the one sense, it's like there is a value to repetition and to going back over the basics. Everybody who's practicing IBC, not everybody, virtually everyone who's practicing IBC or is involved some way is familiar with the phenomenon of reading Nelson's book over and over again. Like there's a point to repetition. So some of that's okay. But then, there's a desire, at least I have like a desire to go further, be relatively original, expand further, deepen further. So having an event like this, having this podcast is like a good feedback mechanism for me to continue to push further, right? To like go deeper, explain better. Because there's still features of like my process that are not necessarily bad. Like there's anything wrong with it, but it's curious to me that, we go through, we have this, someone will come to me, they've watched the podcast, they've watched the mechanics series, they've read Nelson's book. We've gone through an advisory process. There's a few hours prior to getting into an application and almost simultaneously an illustration review. And there's still this element of surprise. Like, oh, that's how cash value will grow over time. Or, like there's still that, even after all that initial buildup, there's still moments.
We should just write a book and then they'll read the book and watch the series and listen to the Banker Live podcast. And
yeah. Well, I think some of that'll help. But my point is that there's still this room for opportunity to, mitigate the surprise factor or like to clarify things in such a way so that seeing cash value growth on a page isn't surprising. Like that it just would follow naturally, right? There's still some space between here and that point to make up. And so I think that it's worthy, is my point, to continue.
To be repetitive?
No, not just to be repetitive, but to refine and to sharpen and like convey, or maybe develop a better appreciation for nuanced elements of what it is we're doing with IBC and with whole life that maybe isn't fully understood, from the get-go, or even after all of this exposure to these ideas.
I get it. I don't want to say a large part, but our conversations about the event and our talks have been filled with, not being overly repetitive. I don't want to stand up there and quote Nelson for an hour. As an example. No, not necessarily, but I do absolutely want to convey and remind myself and others some very straightforward, simple truths about the infinite banking concept that it's easy to forget or easy to get, I don't want to say get lost, but overlook, step right over the very simple things, looking for the complex missing element that we're all looking for to take us from here to there, as you say. And that distance for all of us is different and changes. I might fully grasp an idea or a concept and I'm all in with life insurance and banking. And then 6 months later, I don't know how many times this happened. It's like, oh my gosh, I overlooked that. I didn't even think about that, but I heard it. And then when you look at it again, how could you possibly miss that? I've been shaving for 50 years. What? There's a nose on my face. So bridging that gap. How do we bridge that gap from here to there? Yeah. And it's different for everyone. So it is a challenge, and you don't want to be repetitive. You want to bring value. You don't want, to use lazy words like I'm doing currently, let me tell you what, because I've got my talk 30,000 foot overview mapped out, and it's changed a little. And I was thinking to myself just earlier this week, what I'm so grateful. I'm personally very grateful for the opportunity to be able to go and speak about the infinite banking concept. And I'm not just saying that, and I mean that. And here's one of the reasons why. It makes me reflect on what I'm going to say and where I'm coming from. And it forces me to reread Nelson's work and listen to him, and then go just mentally through what I'm hearing and what I'm reading, and then drawing it out and considering the application that going forward or that I have done in my life. I mean, it's a real blessing to go deep into Nelson's work. And as I say that, it's so simple. He says it over and over. It's so simple. I don't know why we jump over sometimes the really simple, easy, apparent, obvious things that are pointed out and laid out, and we're still looking for that thing that's going to close the gap for us. So
like the other shoe to drop kind of deal.
Or I'm just missing, if you just made the right presentation, okay, if you just drew enough squiggly lines and to convey to me whatever it is that I need to close that gap. So if you do a really good presentation, I might get it.
Yeah. So you have some skepticism about that mentality.
No, my point is that I think that is a real mentality, and I'm just saying you, and like James, if you say the right things, if you just give the right presentation, and this is some of the, self-reflection too, right? You'll help somebody, or the listener is like, I'll get that. And that may be true, that something could be said in any presentation, and points are made and received, or first grasp, and it's like, oh, dots are connected. But if it was that dang easy to convey this, Nelson wouldn't have took 10 hours. And how do you go and listen to Nelson 5 times, 6 times, 7? How do you read Becoming Your Own Banker 3 or 4 or 5 or 6 times, and you still walk away with something new that you didn't hear previously? I mean, what's going on there? What's not connecting?
Yeah. Well, it is a lot. I mean, it is a complete paradigm shift, a transformation in economic thinking, I think, for people. So
it's real economic thinking.
Yeah. And like the idea of getting up in front of a crowd or writing a book or whatever the form of expression, to say that I'm going to go teach IBC, like, I don't think that can be done in a more efficient fashion than Nelson did. I mean, and there's a sense too in which IBC is so much a part of like who Nelson was. It's like, in some way, in order to convey or attempt to convey the IBC, you're going to miss the mark because it's not coming from the source. So there's a necessary degree of separation that'll happen, and that'll maybe present the opportunity for new confusion or distraction, but maybe also the opportunity for some refinement or sharpening. But it's going to be different than the original exposition is and was from Nelson directly.
Absolutely.
Is kind of the point. But I think that given that whole context, that there's still plenty of opportunity, of headspace, of whatever you want to call it, to explore the quality of the product itself more. There's that, I think I've mentioned on here before, and I've certainly talked to you about it, but that Jim Rohn quote, the interested want to know, will it work for me? The fascinated want to know how. I really like that. Like the idea of being fascinated to point of wanting to know more than somebody who's just interested would need to. And just what I was mentioning to you before the show, what I thought about over this prior week, is the nature of value generation in the contract itself. I mean, it's almost like it's not almost, it is the way it is that value is manufactured, generated, created in this particular kind of property in a way that's so distinct from the way we refer to financial value of other property, right? That we're constantly, the house is worth what somebody else will pay. The value of the stock market holdings is worth whatever you could liquidate for, less taxes and fees if they're in a tax qualified. Like, we're all used to this idea of value being contingent on what somebody else in the market will pay, and you don't know what that is. So there's this inherent uncertainty. And the idea too that things should be purchased on the expectation of appreciation, that there's going to be some increase in the value of what somebody else will, in the market. So an uncertain, non-guaranteed, expectation of appreciation. And this is just what one is supposed to do, right? You invest, you buy it, and so we have this. We have this like intuitive or conditioned or trained kind of understanding of what it means to have property of value, to accumulate capital or to accumulate net worth at whatever resolution you want to think about it, right? Whereas in whole life, the nature of value generation is so much different. Right? We're harnessing this relationship between a future cash flow, a future value, and its present value. And it works. That can happen because of this bizarre fact of life, called the law of large statistical facts, empirical statistical facts or regularities, combined with mortality of all things, right? Literal life and death. Like, life and death happens in such a way over a large enough number of numbers that if you can observe that and track and acknowledge those empirical regularities, then you can establish pricing relationships between now and future cash flows in order to engineer this value growth, this ownership as equity, this capital, financial value in this contract. And the contract is not even really the property. I mean, it is technically the property itself, right? You own the policy, but it's not like the value is in the paper and the ink on the page, right? Like the contract just enumerates the underlying property, which is the agreement, like this binding legal arrangement with this company, like this mutual that consists of other people doing the same thing. That's so bizarre.
You just introduced the idea of mutuality.
Right. But that's
with all of these numbers.
Yeah. And so then you apply the law of equity, like a very old common law, British common law type philosophy principle, where there's this moral admonishment that the individual should, in that arrangement, in this context of paying premiums for these specifically priced future cash flows on the basis of the law of large numbers, on the basis of the fact of mortality and the observation of life and death, like the idea on top of all of that the individual who participates in it is entitled to, has like some moral or legally enforceable claim to ownership in that whole operation, which is compensated by a dividend. Right, like the important part of this is that you have a moral justification grounded in British common law for the origination of a cash flow, a dividend, participation in the financial surplus that collective generates, well, when it generates it, right, year to year. And for that cash flow to also contribute to the additional increase in value. I mean, there's an elegance, like when people first learn Austrian economics, you go way down the rabbit hole, Mises Institute, read Mises, Rothbard, Human Action, Man, Economy, and State, and go through all this. There's this sense of for some people have reported, when you get the gist of it, when you get the general features, to kind of stand back and be like, wow, there's an elegance to the integration of all those different philosophical and logical deductions. And it's really impressive. I get that same feeling in reflecting on the nature and origins of a whole life contract. And to say that So then you stack all that against this tendency online to present whole life or to present its features in the context of just conventional advising. And I'm like, man, you miss so much, right? Like just because the ink on the screen or on the paper, is shaped in the same fashion, like just because numbers look like it does not mean that the quality of those figures is the same. And I think there's a very unique, compelling quality of the values that pertain to whole life, death benefit, and cash value that if you can comprehend are extremely compelling, is my point.
And if one could comprehend these things, bringing in British, common law of equity, the idea and the concept of equity, the idea and the concept of mutuality that includes morality. Mm-hmm. And then the number, the law of large numbers, and then the idea of statistical life averages and accounting, putting all that math together. So if somebody can grasp all of that, they've gone through the exposure, the initial, exposure to this idea of the infinite banking concept, and because you will generate an annual statement if you have a life insurance policy, and it might look similar, might not look similar to an annual statement from, an investment company. Of course, it'll be a different format, but they're all just numbers on a page, right? So if I can go through all that, just ruminate on the morality, the mutuality, the idea of life expectancy and medical underwriting, statistical life expectancy and actual life expectancy. And so I would back up and see the construct at some time and just be in awe.
Yeah.
Right. Okay. So, if you can convey that, isn't that a challenge to share, and explore all of this information in a way that you can consider beyond the financial construct, no question. To get to that point, it's like, wow, there's really something here.
Yeah.
Do you think if somebody could go through all that, that would close the gap for them?
I think it would help. Yeah. Different people are going to have their different light bulb moments. Certain particular things that really make you go, oh, wow.
Yeah. What was some of the things for you that made you go, oh, wow? Young Mr. Economist.
Yeah.
Come on.
So the first thing, and the internal mechanics to this were not immediately obvious to me, but this was like what really sparked it. I think it was 2015. I'm trying to think of when exactly this was. It was either very late 2015 or very early 2016. In going through Becoming Your Own Banker for the first time, read the book in full in a night, right? But in equipment financing in particular, that cumulative net outlay column, to just flip from page to page and see that number go up, that was the first okay, and cumulative net outlay, I understood what that meant. So to have seven figures, 2 million and change, depending on which illustration you look at, to see that much in cumulative net outlay, so cash flow net of premiums paid in to the individual over the course of a lifetime with conservative assumptions, right? Mortality at, was it 85? Started in just early 20s. This is not 30. There were no grand assumptions there, right? And in fact, then you little layer deeper in the narrative itself, where he's explaining, that 25 grand per year in PUA, that maximum is not getting paid year 6 and beyond. Some PUA is getting paid, but you're not hitting the maximum. The dividend is assumed to be taking care of the base premium after that, in that 5th year and beyond. So what this presentation consists of is a lot of conservative, maybe you might say suboptimal type assumptions for a purpose, right? The point was to show a change in the cash flow from Associates Finance to a life insurance company at the same magnitude, right? $1,500 a month in payments for the equipment. So there were reasons for the maybe relatively suboptimal type assumptions that, relative to the context of today, if I want to the goal being to maximize PUA premium payment for as long as possible, for instance. But even then, to show these big cumulative net outlays to the individual, and for that number to go up as a result of what the individual did, like that idea, right? That I'm, by me changing my action, I'm engineering a different, in this case, in the case of equipment, an increase in this cash value year to year, and thereby potentially engineering an increase in my late life cash flow, all post-tax, right? Like that, you start to add those layers, and that was what, to me, was like, okay, what's that? I wanted more. That's
why I did it.
I wanted more. Yeah.
In 2015. So, and then, okay. And there's equipment finance was the really favorite part of the book to me, and still is, with an even distribution of age classes. It was about $500,000 in cash value each illustration, from 1 to 2, 2 to 3, 3 to 4, 4 to 5. And then, and you can read it in there, but that thing was so inefficient. That policy was, I say so inefficient. It could have been more efficient.
Yeah.
And it was eye-opening to me too. But okay, so when you go through that and you want to know more, what'd you do? How did you seek this more?
Before fully, and I still don't fully get it, don't get me wrong, but before kind of understanding why cash value would grow in that fashion, before getting to the bottom of that rabbit hole, I immediately went online and looked for Nelson. So found he was still doing his seminars at the time. So this was in Northern California. I think it was in May of 16. Yeah. And found that he was doing a talk in January of that year, attended in May of that year. And so then it went deeper and deeper from there.
Yeah. Well, that was the next best thing that anyone could have done, is listen to Nelson live.
Right.
I mean, and then it's just been Katie barred the door since.
Yeah. The capital element, understanding the value, understanding cash value as capital. That was a big level deeper.
Yeah. Well, you were, I don't want to say struggling, but you're deep into the Austrian theory of capital even then.
Yeah. It's still the subject of my dissertation, and that it's to see the economic integration has been a big deal. And then to explain that to clients. I got an individual going through the advisory process now, and mid-30s, successful, works in technology, runs a company, has a startup, this kind of stuff. For his age, makes a fairly good living, just statistically speaking. And as I find so often with many people, but maybe in particular people who have done relatively well in their income generation, in their profession, in their on the economic side of life, there's this importation of terminology from the conventional financial sector, right? And there's a process of unwinding that, sort of not unlearning, but just putting that in a box over to the side and learning the new, meaningfully new and different terminology in whole life. And one thing I've found that is helpful in explaining that from like a substantive strategic perspective is the capitalization versus investment dichotomy, right? Like the purpose of this is to retain, secure, and grow value that you have access to, where the whole point is to maintain access to it, right? Whereas in investing, yes, we want value accumulation. That's fundamentally the idea, but the question is control, right? The purpose of investing is to give up control over that financial value to somebody else on the conditional expectation that there's going to be some cash flow in the future. Okay, great, fine. But for there to be this meaningfully, conceptually distinct domain of financial activity, that is very compelling to me. Like to structure things, and it's my point in bringing all this up was that has been reported to me as helpful and effective in structuring thinking around what this is, right? Like how it fits with the other things. And that is really, as a client described it to me as a slippery slope earlier this week. He's like, once I see the numbers, it's always once I see the numbers, this may be a slippery slope. I may want to go all in. I'm like, yeah, probably.
Just show me the right illustration and I'll go all in, huh?
Well, I'm smiling on the other side, because like I can kind of by now understand or intuit by the questions people ask or just the language they choose, the degree of understanding. And you can kind of peg the degree of understanding to the intensity of one's commitment, right? To the desire to pay premium, right? And it's independent of someone's particular income level, but you can kind of get a sense of, okay,
that could be applied to anything, right?
Oh, of course, exactly. If someone's really into it, well, then you expect, action, proportionally substantial action, right? And so it's always, when people start to voice that or acknowledge or observe that hesitation or that feeling of like, this is changing my thinking. Like this is changing how I'm going to treat my cash flows. And that's a big deal to people, right? To have that effect. Not many bodies of thought cause that fundamental or that systemic of a reconsideration, for your own finances, for your own cash flows. And so it's a cool thing to hear happen. And then, I talk often in terms of a percentage of income allocated to premium. That number sort of starts to go up to a certain level. And then you see that reflect in the premium numbers. And of course, the higher the premium, the better the cash value growth. So like
What?
Yeah. Anyway, my broader point, going back to the very beginning of this, is I think it would help people. It certainly helped me to have a more technically accurate understanding of the internal makeup and structure of these policies. What the textbooks, what academia refers to as the pricing of life insurance. It's really a explanation of the makeup of a contract. Like if people understood that better, I think it would help.
I think that would
help sharpen the whole image.
I think that would help some people, diving down on the technical aspects of life insurance.
Yeah.
And it'll probably help as many people as it wouldn't help.
Oh.
I don't know that, but the non-technical person doesn't want to get drug out into the world of technology and beaten to death, right?
And don't get me wrong, I'm not saying any of this is necessary.
Well, no.
Right? Like you don't have to become a master of actuarial science to implement IBC.
I completely agree. But we're speaking really generally of the challenge to convey the work of Nelson, to convey the idea of the infinite banking concept. That's the challenge.
That's the challenge.
And then whether it's technical, emotional, or anecdotal, or mathematically, trying to convey this idea. That's just the challenge. And to me, you can't really leave the math out, you can go really deep into the mathematics of a life insurance policy, and especially whenever you have the law of large numbers and mortality, right? And we were talking earlier about this idea in the British law that all of this information, the statistical information of life expectancy, comes from Uncle Guido, right? The 10-year census. Mm-hmm. And more accurately would be the life insurance company's experience.
Yeah.
And then I wonder how much they share that information between each other, which is Neil.
My understanding so far is that the mortality tables published by the government form the basis of individual state mandated non-forfeiture rate calculation, right? So that serves as the sort of a price floor, the minimum basis. And then that individual companies likely use their own data for internal pricing that of course conforms with and meets the whatever thresholds are set in place on an individual state by state level. But then I would imagine there's degrees of flexibility above those regulated minimums in order to price things potentially more in line with the company's own experience. And I think that as to what degree other companies publish and share this stuff, like my reading is like the major huge number reinsurer type companies, with holdings globally will publish, they'll like internally hire a private type entity to perform analyses, and then a sort of groomed selection of that data is published.
Massaging some numbers is what I'm hearing.
Yeah, I think the release of like the raw data within company, I think that's probably not the thing that happens, but like these companies of a certain degree of repute will publish these various kind of reports to comment on the nature of trends in mortality data. And I think there's enough, but from the state regulation, my sense is that there's enough from the state regulation point of view and whatever information sharing there is within the industry, plus a century or more of experience for the industry, for there to be something like a general type consensus in the pricing. Like it doesn't seem to me like you're going to go like from one company to the next, there's going to be some wild difference, in the nature of, let's say, cash value growth over time.
Yeah.
Now that I think there's differences in the individual quality of the product, right? Like the terms and conditions governing the various features, company to company. And I think there's a meaningful selection margin there. Like part of what I think a focus, or at least the more careful consideration of the structure of a policy can do is point out that there's only so much difference between the companies, right? Like you can spend all day, and it's a wonderful like resistance post that if you want to grab onto and like delay action, delay getting started, delay paying a premium, you can get hung up on the idea like I'm going to compare, every, go through the 250 page annual financial filing of the various companies and, make it a big issue. But I think there are meaningful criteria on which to compare compare companies. But from the valuational, like from the cash value growth dynamic perspective, I don't think you're going to find a major difference.
I agree. Math is math, and there are only so many bonds in the world. When you pay a premium, that money is the property of the life insurance company. They have to put that value to work to meet the future obligations. I know it's simple, but not one person ever in the life insurance industry explained this to me. Not one. So it's been a revelation for me over the years, and I'm still in awe. That is not my money. That belongs to the life insurance company. They have to put that value to work to meet their future obligations. I'm going to die. You're going to graduate. We're all going to graduate. And we're all, subject to get mad and quit. Right. And then there's a cash value that's guaranteed that I can get mad and quit and walk away with. Now, it accumulated partially guaranteed and then partially non-guaranteed as a dividend, not overlooking that at all. But once the dividend is paid, it's paid. Right. The value of that dividend is not going to go down in the future as compared to a stock dividend. I mean, I might get paid a dividend and might reinvest the dividend in the stock, the dividend reinvestment program. Right. That stock value can still go up and down. All right. Not so with life insurance. And so there's that idea that it's not my money. It's the value of the life insurance company. But contractually, I can get mad and quit and walk away, or I can collateralize that. Mm-hmm. I mean, that's pretty dang powerful to me. In the financial world, 30-something years, we can get lost in the technicals of anything. We can get lost in the technicals of the market. Mm-hmm. Right? We can get lost in the math, quote unquote, of Wall Street. You're not going to out math a life insurance company. It isn't going to happen. Right? Now, we can dig our feet in the ground and just disagree with different ideas, fundamentals, philosophy, or whatever to postpone making a decision or to justify ourselves from making or not making a decision. There's no question about that. But there are so many bonds, to purchase when you pay the money to the life insurance company in the form of a premium. They have to put that capital to work to meet the future obligations. There's a limited amount of places that they can put that money. And there's only so many bonds out there. Mm-hmm. So you have all these life insurance companies tracking down the bonds, tracking down the real estate. And it's all math, and there's some variable within the product design of a life insurance company. They can hide cost and margins, and you can make things up here or there. You can support the dividend from other sources in the enterprise. I don't know how many times these big life insurance companies have sold off very profitable arms of or assets that they own to support a dividend. So things can happen, right? But when you look at the philosophical differences of the life insurance company, they do exist, right? And we can even into the infinite banking world. Some of these life insurance companies don't want you to borrow. They don't want you to exercise your guaranteed right, sir, to collateralize that policy. Yeah. Wonder why. I get it. They don't have tellers, and they're not a loan. They don't have a loan department. That's a service. I get it. And if they have hundreds of thousands of policyholders and just a moderate fraction of them wanted to exercise their right to collateralize the policy. Mm-hmm. I mean, I understand that there's a lot of similarities in the life insurance companies. They all work on the same mortality tables. They all have the same distribution costs, whether you're paying an agency system, an IMO system, or a banking system, or a brokerage house. The distribution cost is the same. The investment returns are relatively same. The further out you go, of course, the greater point that the greater the results of similarity occur, right? But what happens when a little company makes some bad decisions because of philosophy, and then they get financially upside down and have to have a hedge fund out of Canada to buy them, right? So these principles are true. These fundamental facts are facts. There's a limited amount of capital. There's a limited amount of places to put that capital. But the investment guru at a life insurance company, one can be different from the other. You get the board of directors and the management of a life insurance company. The decisions can be different. So I think philosophy is very important. Technically all life insurance is the same. Technically, I don't care if you're male, female, 20 years old, 30 years old, or 60 years old. The cost of the death benefit is all the same when you technically go through it and look at the math. But the challenge is conveying the idea. What if I'm going to go from here, wherever I'm at currently, to understanding to the point where, I don't care what the markets do or don't do, and I don't care what my brother-in-law says about the gargantuan premiums that I'm paying in his perspective, right? How do you close that ground?
Yeah. Well, part of it, to me, going back to that capitalization and investment framework, is to make the point that this is a systematic difference. Like trying to market whole life or other permanent life type products as an arrow in the quiver, a tool in the toolbox, the conservative part of the portfolio, however it's communicated, in order to make it all seem like this is just one other option in the set of conventional options. I think that's unfortunate. Like, no, you should say that this is a fundamental theme in IBC is that there is a stark distinction between what the conventional approach is and this alternative. Like, there is a difference. It does matter. It is pretty dramatic, right? Like we are talking about a substantial percentage of income. We're talking about multiple years of premium payment. We're taking a lifetime perspective, even beyond. Like, this is a lot. This is different, and you can, the scale of your income may, if you earn a lot, you got a lot of cash flow, then a nicely suited system may consist of a big premium number, like a number bigger than any other number that you might deal with, in transactions in your otherwise ordinary economic life. Like there's a lot, and so I think one way to help make a connection between, I'm interested or ignorant, and on the one hand, and I'm committed, let's go on the other, is to point out that, this is definitely different. And I don't think people should shy away from that, is my point.
I don't either. I think that, when you refer to the investment world and trying to placing life insurance, especially Nelson's work. Yes, the just the infinite bank concept in becoming your own banker. Yep, we're using life insurance. There's no question. Dividend paying whole life insurance issued by a mutual company. And when the quote unquote guru, the financial person, places that, tries to put it into the narrative of financial planning or the investment world, it is exactly speaking. That's the evidence of their not being able to close the gap. They're trying to put this life insurance into their framework of understanding, right? Wow. And they're conveying it in the interest rates, being dumbed down to the lowest common denominator. Or I'm improving it. See, they can't finish they can't close the gap for themselves.
Yeah.
Okay. Much less close the gap for others or help close the gap for others. And it shows it. And when you first opened up this conversation, whenever you speak with people and you hear the language that they use, you can tell what they're reading or what they're listening to or what track they're running on, and maybe even a little bit of what they might understand and a little bit of what they don't understand. The struggle is real to wrap our mind around this. Yeah, we can look at numbers on the page. I can see a cash value go up 500,000 over, 5 different times over 5 different illustrations. Yeah, I can see that. And then, well, technically, how's that happen? The non-technical person may not give a dang how that happens, right? Where the technical person, they want to know exactly, wait, Nelson paid the base premium with the dividend. The dividend didn't equal $15,000 until the 12th year. What's really going on there? Oh, that happened 23 years ago. That's exactly what I spoke about last October in Fort Worth, Texas, the changes in the industry that have occurred since Nelson published the book in 2000. Mm-hmm. Just the CSO tables, exactly, the life expectancy that's counted and tabulated by Uncle Guido. Hell, he's killing us. If he'd get off our back, we might live longer. Okay. I'm just saying. It's a challenge to convey, right, the power. And whether you're technical, you're non-technical, I agree with you. You should have a fundamental understanding, enough of an understanding of life insurance so you can understand the structure. I know in the industry, I get beat up all the time. You're getting lost in the weeds, James, talking about structure. No, the hell I'm not. Just because you, whomever you are, feel like that's off into the weeds of structure, let me tell you why I don't believe I'm getting lost in the weeds of structure. Because you just throw out an illustration that looks good for 5, 6, 7, 8 years if nothing changes, when you know damn well everything's going to change in the future. And then you put that I'm just saying, you put that soul in the position where the death benefit goes down, they can't pay a premium, and all of these different things. Oh, wait. And then they become uninsurable. You haven't been in business long enough to see somebody come uninsurable? Yeah, well, it happens, right? Structure does matter. Should you live and die on structure? Maybe. Maybe. Anyway, that's another example of the agent advisor's inability to convey the power of Nelson's work and dividend paying whole life insurance to force it down into an illustration, rate of return, or whatever. Mm-hmm. It's a weakness that they should spend time trying to improve their understanding.
it's a lot of these dynamics all kind of flow together. So like that, what you're describing so frequently comes with these different marketing strategies where it's always showing the tabular detail, maybe even the raw tabular detail from the illustration document itself, or just the, copy paste of it. But
or I love the third party software.
It's numbers on a spreadsheet.
Oh my gosh, to manipulate.
Yeah.
That's the point. Okay.
And then the presentation of those numbers, and the emphasis is always on a larger cash value figure earlier. Like the idea of a policy being a structure into which cash flow, where you're going to have inflow and outflowing cash for the rest of your life, like that whole idea is gone. It's just about how do we manufacture, how do we generate this cash value as early as possible, and that's assumed to just be. That's why it's always so implicit. I guess I don't even know of sources where this implicit assumption of high cash value earlier, where the argument for that is actually made. Like, why would that be a good thing? Well, it's just sort of assumed that higher, earlier, better, but that jumps over the effect in the long run, and the implications of a longer term perspective are meaningful in the present, right? You're going to do different things. You would select, or the idea would be that it would cause you to select different things in the policy purchasing process. Like your perspective will have an influential effect on the nature of what you do today. So if you don't talk through the perspective, if you don't specify the term over which you're attempting ostensibly to optimize, you're gonna end up with something different in the present, and then ultimately in the long term, right? And then all sorts of things come in to compound that. Like if you consider that, statistically speaking, the older you get, the more money you'll make. You can only get so much insurance. You can only have so much death benefit. You're only going to be able to get, as you've pointed out, only going to be able to get insurance for so long and so many amounts. Like the nature of your relationship with the industry in terms of what you can get the right to pay in premium will vary over time. And so there are implications there, right? Like how would I then approach the initial layout, the foundation of my system that's going to grow over time, given those considerations about the way the industry operates and how much they'll let me have and when they'll let me have it. Like that'll affect how I do things.
Well, hell, we don't want to talk about all of that. I just want to get down to an internal rate of return. This number's bigger than that number. Comparing illustrations when the construct of the policies are different. Right. And everything about them is different, other than they've been issued by a mutual life insurance company.
Right. There's some basic similarity.
Yeah. They may or may not pay dividends, depending on if there's a loan outstanding or not. There's some limiting factor on how much death benefit you can get through a PUA or a ratio of premium. No kidding. You mean the life insurance company is limiting their exposure to your death in life insurance? Oh, what a concept. And what do you mean by that, James? Well, you can only have, it's like, so this has been presented as a fundamental unknown truth, which speaks to the correct structure. Oh, you can only put 10 times the PUA to premium to the PUA compared to the base. Oh, you can only use 12 times the death benefit on the PUA compared to the base. Oh, you can only use 10 times the term rider death benefit compared to the base. Oh, you can only put 10 times premium into the PUA compared to the base in year one. And then in year two, it's 3 times. And then year 3 and beyond, it's only 2 times. And if you don't do that 7 years after this, or if you don't do that years 2 through 7, you lose the right to even do that. Mm-hmm. I mean, all of these things, and they're different across the countries, the limitations.
That was very good, though. I know exactly what you're talking about.
Thank you. Yeah, it's like it's not some thing that I discovered, you discovered, an agent or an advisor discovered that's going to make the difference for you to close the gap. It ain't, all right? That ain't it.
Yeah.
Okay, so I err, and I'm kind of a non-technical person. I mean, I can, do repairs mechanically. I've done all of that I want to in my life. I built fences, barns, houses. I'm somewhat of a technical person. But I don't want to get lost in the technicalities unless it's a deal breaker. If something technically, I want to know the rules of the game, right? And there's some technicalities involved in that. And I want to know what they are. I want to know where the third rails are, right? I love numbers and I love math. I don't like all the equations, but I love math and I love numbers, but I don't have to be a mathematician. I mean, I've been enough of a mathematician with life insurance to know, and I've got mathematicians as clients, mathematicians. You're not going to outmath a life insurance company. Yeah. It is not going to happen. It isn't going to happen, right? And so, for the financial advisor, you can create whatever kind of an illustration that you want, and kind of going back to, you build an illustration and you get down to the reasons why, proving that, supporting why a policy is structured the way it is mathematically. It's always with some third-party software. Well, if I have 90% cash value or 80%, whatever the big number is of cash value in the PUA in year one, then I can exercise my right to borrow that value, that amount from the life insurance company, and then go create a rate of return there. Mm-hmm. So I'm going to compare that to cash. I'm going to compare the real estate in the always up market and only do deals for 20%.
Yeah.
I mean, what basis am I going to add and use this third-party software in to create all these fabulous numbers when the structure was wrong?
Yeah, I'm sure there'll be a thorough explanation of that on whatever video it is. Yeah, no, there never is, right? And getting caught up in the
is there even a video?
Yeah.
It's like you click in, watch this webinar, and it's like,
yeah.
Okay, I digress.
And I agree. Like you can get hung up on the internal computational technicalities. And I don't like this. I don't enjoy this. But when people send me their spreadsheet, and I know it's all in good faith and we're learning.
They're just trying to close the gap.
People just trying to close the gap. Yep. It's probably the title of this episode. AV people, but that certainly frustrates me in looking at the spreadsheets and, hey, I built this model, given the numbers on the page, does this help or advance or clarify? And it's like, yeah, probably not really interested in reading all that. I get all that. I think the approach to the internal actuarial technicals, people sort of assume that means we're going to go do some computation and compare numbers on a page. And that is not what I mean. Like, I think you can study in essence, non-quantitative, but still mathematical design of these policies, right? Like understanding the relationship between the categories of the numbers, how mortality experience interacts with net single premiums, interacts with net level premiums, interacts with cash values, interacts with death, like understanding those functional relationships. And there is a mathematical relationship between them. I think there's ways to do that in a pretty non-quantitative, non-computational fashion. Like you don't have to sit. I think it can be helpful to like do a highly abstracted example of going from a mortality table to, let's say, the calculation of a net single premium and then the net level premium. That could be interesting to somebody and that would be quantitative, but I don't think it's necessary. I think you can explain conceptually the relationship between these numbers in a fashion that generally hasn't been done, that I think you could maybe from the outside looking in would say, oh, that's super technical, but I don't think it's necessarily a mental holdup. People who genuinely want to explore I think might be interested in something that explores that non-quantitative mathematical setup a little bit more closely. That's what I'm talking about. Because there's always going to be, people always will find a reason to say no. And there's absolutely a sense in which additional mathematical type work or study of the internal actuarial mechanics, I'm sure that'll be used as a source of resistance. And whataboutism, I'm sure, no doubt in my mind. But I think that it would be helpful for people who just plainly want to know. And it supports, I keep going back to this, but it supports all other kinds of conclusions that you'd come to when thinking about IBC in the context of conventional insurance. Like it supports why cash value is different in nature than value in something like a stock portfolio or tax qualified plan or whatever, real estate, whatever else it is. It supports all that. It supports fears about inflation. There's a dollar denominated asset
right.
that values in US dollars. The dollar's going to collapse. Blah, blah. It's like, yeah, no, this is really about, again, the relationship between numbers over time. And if one understood the nature of cash value, then in a threatening price inflationary environment, you would want even more of this, right? You would want to expose even more
Absolutely.
Of your ongoing premium to this systematically compounding growth curve, right? You're literally offsetting your relative fall in purchasing power in the rest of the economy by boosting your own purchasing power relative to your annual cash flows. Right, but if you understood the nature of the contract, just again, mathematically, conceptually, but not necessarily quantitatively, if you still understood those relationships, it would help clarify that dynamic.
I think
those are just examples.
Absolutely possible to help clarify.
You're skeptical.
No, I'm not skeptical. No, I'm serious. I really, I thoroughly agree that, that work should be done. I mean,
it's fascinating to me, like this is really different.
Yeah, because it is, and it will help a lot of people.
Yeah.
And there'll be a lot of other people that, I'm glad that you did that. And I appreciate, seeing that.
Yeah. And, to me, because we were talking about like when I first light bulb initially went on, becoming a banker, equipment financing, one feeling that came along with that was this is going to sound like gooey, I guess, but like the excitement that comes with discovering the possibility that there could be a whole other way to go about this compared to a whole system where it's not compelling at all, right? Like tax qualified plans, government partnerships, government limits, changing rules, business cycle, the news stories about the collapses in the portfolio, totally unexpected, having to going back to work, whereas you didn't expect to, or you thought you were going to retire and had this whole other plan in life, and just having this source of late life surprise, to the downside, and nothing about accentuating or improving your ability to act economically in your own sphere. There's no discussion really of how best to manage finances to prepare for the possibility that you might want to go to work for yourself or start a business or just transition to another industry. All of that's considered something else. Whatever that is, it's something else. It's not the domain of financial planning or strategy. That's self-help or psychology or whatever it is. But just to think of finance as this thing that you do that excludes all of that, preparing for your own type deal, preparing for entrepreneurship, accentuating your ability to impose your will in your own domain. That's not part of the discussion. It's just tax qualified plans, major Wall Street corporations, financial products you don't really understand, the mutual funds, exchange traded funds, ETFs, all these different machinations, feeling like you're contributing to the problem, right? You're supporting these institutions that don't like you, right? I mean, they're all World Economic
hoping that you'll be
type.
Wrong and it'll turn out really well.
None of this is built for you. I think that the delusion is fairly shattered that Wall Street's not looking out for you, how to help you. And it doesn't take much, Nelson used, it doesn't take much on the tax qualified plan front to start to see through that. Oh, the government's created a program to help me. Oh, how naive am I? Is it pre-COVID or post-COVID? I mean, it's that is so bleak. Mm-hmm. And if you come at an evaluation of that, like I did from this Austrian economic business cycle, monetary economy, or monetary economic type view, that gets depressing. And you can get real lost in the Federal Reserve stuff and the history and all that. It just gets worse, So to find that book, to find that part of the book and to consider that, wow, there could be a way to exist and operate and manage functionally, deliberately, on purpose, in the financial domain that's not all of that, that to me was very exciting. Really exciting. You know, like the kind of thing that changes, I mean, it has obviously changed everything you do. And so that part of the conversation with clients where that surprise starts to seep in and you start to hear in their voice that things are going to change because of this reconceptualization of how things work financially. That's pretty cool, you know? And the hangups are going to happen. I think the hangups of the technical stuff is going to happen. But for the genuinely fascinated who want to know more about the how, I think I'm going to do a little more stuff on the life insurance pricing, that actuarial stuff. We'll see.
You just went off a cliff, man. You were just like all excited.
Well, that's the conclusion. Because I've only done so much of it so far, but my point is I think there's a lot more room for understanding of the actuarial fundamentals, even though it's not necessary. It's not necessary. And I've had to get over that. I'm like, well, you know, this isn't in Nelson's. This isn't in Becoming Your Own Banker. It's not in like foundational documents. Like, is it going to be valuable? It's like, well, I want to understand it better. And I think people do too. I wish more people could have that feeling of surprise. Oh, maybe this is where I'm going with this. I wish more people could experience that same feeling of surprise and discovery in seeing how things could be different, right? Not just that they can, which is big deal enough, but to get an idea of how things change over time, I think would be helpful. So there's gonna be more of that, is my point.
And I think it would be helpful.
Yeah.
You know, I think the feeling that one would get whenever they heard Nelson, I don't care if for the first time, second time, third time, giving his presentation, going through Becoming Your Own Banker. I mean, at some level, at almost every level, different levels for the different individuals, there was a tremendous element of surprise, whether technical, you know, maybe their background, the listener had foreclosures, you know, bankruptcies. Maybe they were dependent or had been dependent upon third-party lenders. You know, maybe they lost money. I mean, they've all had their personal experience and the diversity of that. And then hearing Nelson systematically walking you through, making you think through the paradigm of what's really going on and then what you've been told without saying these things. Right?
Yeah.
I mean, he's just walking you through what's really going on in life, what's really going on in the financial world, what's really going on in your personal financial habits, and then educating you very simply on the characteristics of life insurance. And you thoroughly understood that whomever is and was and is performing the banking function is the most profitable person in the conversation. And it's likely not you. You know, these, oh my gosh, surprise, anger, overwhelmed, overjoyed, you know, a lot of different emotional feelings, but knowing, you know, at some level, you might not be able to put your finger on everything, but knowing at some level that you really could make a difference. I mean, there's a tremendous element of hope, you know,
yes,
of real hope, not that, you know, the IRA 401k is going to get a great big rate of return or whatever, but a real legitimate basis for you, whomever you are, to make a real legitimate improvement and change in not only your life, but the future of your people.
Yeah.
Every time.
That word relief, that there was a relief in that surprise for me. Because as I've sort of discovered recently, a lot of my own activities are motivated by the fear of vulnerability, right? And one major source of concern, of feeling of vulnerability, is the potential for just sudden, outside of my control, collapse in financial value, right? And how much you're able to get to in your capital position. Like that is how that could not be a source of concern for people, to me, is difficult to imagine. Maybe I'm the only one. Maybe people are like me, but not everybody. But I find that to be like fundamental. Right? Nelson used to talk about how the source of most people's problems is money. Right? For me, it's that, in particular, vulnerability. So to be exposed to and see, to have a sort of like general visual understanding of this path of like, this is possible, this is how this would go, like here's the track you would run on, for that to be there meaningfully, like in an understandable, intelligible way, not I'm going to get everything, not I'm a, accredited actuary, none of that, but like sufficient conceptual understanding is such a relief.
It sounds like you are still going through some of that.
Absolutely. Yeah. It's really, well, anytime you turn around and meditate on this kind of stuff, it's, again, everything with whole life is conceptual. The policy just enumerates an agreement. Like the operating mechanics are fundamentally conceptual. So the more time you spend reflecting on it, the clearer the understanding of this intangible conceptual thing. And yeah, the relief constantly comes back. And we can make this super relevant, connect it to today, where you've got bond prices going nuts. The Federal Reserve has slowed money supply growth and outright decreased it as a matter of volume at the fastest rate ever in the history of recorded finance for the Fed, and more deeply, money supply for the U.S. Like, this has been the fastest contraction ever. You've had a major yield curve inversion, right? This 3-month secondary over the 10-year, which is now starting to uninvert. And if you look historically, we talked about this before at different times, and I did the talk and I had that paper with Bob Murphy on this, but upon reversion tends to be when the formally dated recession begins. Now that's NBER, National Bureau of Economic Research. They go back, they move start dates. It's all at a lag because of employment and GDP data, and all of that's arbitrary anyway, and the calculation of those numbers change. So whether there's a real recession, as people like to talk about it, is a different subject. But like the formally identified NBER recession tends to happen right around the time of yield curve reversion. Okay, so we're in the middle of all this now. The degree of severity has been fairly dramatic. There's been so much fiscal spending, so-called fiscal dominance on the YouTube financial programs, where the government, under the auspices of COVID, just hands people money. That's going to be quickly, relatively intensely price inflationary of like stuff that people generally buy, as opposed to like shares of stock and stuff. So it was. And then now you got the Fed, whose ostensible role it is to control all that stuff that happens with rising prices. But their effect on the monetary side, on the contractionary side, is at odds with or offset by this ongoing stimulative stuff on the fiscal policy side. So you have these offsetting factors. Prices are not coming down as fast as people thought. So you set the stage for a stagflationary type event like in the 80s, but for reasons that look more like those in the 40s, right, where a bigger factor behind the rise in consumer prices was federal government spending, fiscal policy, as opposed to monetary policy. So you have the same kind of fiscal dynamics as in the 40s, with the kind of money inflationary type dynamics in the 70s and 80s, combined together now at a much larger scale, right, with advances in technology, right? So part of the SVB collapse was like the speed at which these withdrawals happened. That caught the Federal Reserve and FDIC system with their pants down. Like, they didn't have a good response for the technological speed part of the whole process. Happened overnight, quote unquote. In fact, within a day. So all of those factors together, line all that up and say, what effect that's going to have? And let's talk about financial vulnerability now, and in terms of the...
we need a digital currency. That'll solve all of that.
Yeah. And I've heard more now. I wish I had specifics. I will at a future show, but plans talking about making just fiat changes to tax qualified plan holdings. Maybe you get some government bonds in exchange for those equities that we're going to have to liquidate. anyway, the feeling of relief.
That balloon has been floated since the creation of qualified plans, really in the 70s. Anyway.
But the feeling of having a path of, I guess part of my point is when that source of vulnerability, when things appear to be getting worse there, right? The scale is greater, the technology is faster, the volatility is greater, the numbers are larger, right? Like the potential impact from something going wrong in the conventional setting is only intensifying and growing. Meanwhile, I've got this totally other, outside, different way of thinking. That to me is such a profound source of relief. And it's so bizarre because often, not often, but occasionally you get people who will talk and have the initial conversation and you can sense hesitation and like wanting to be cautious, asking sort of, not self-censoring, but like asking certain questions in a cautious way to kind of navigate forward. When in fact, you kind of know on the other side of all that, there's this, what people are really looking for, I think, profound sense of relief. And like, I have a structure. I'm not participating. I'm just not, I'm participating in the extreme in my own system, but I'm just not going to participate or minimize my participation to practical levels in this whole conventional structure, which serves as such a giant source of fear over vulnerability. Like that's, I really appreciate that. I find all of that very compelling. Like it's motivating to me. And I think if more people saw whole life in this manner, then they would experience some of that relief too, which is, I don't know, the goal, I guess.
Yeah, I think that's a result. Not only a goal, but that is a result of practicing the infinite banking concept. And at whatever level, I don't care if you're 75 and you're not ever going to finance anything and you don't have any children or grandchildren, don't need a death benefit and nothing to finance for them. I don't care what kind of an extreme example that you can bring up that might create that post for you to hold on to and say, I'm not interested, which is fine if you're not interested. After a thorough investigation, and to still not be interested, there's some thing, deeply held belief, scar, maybe the milkman was a life insurance agent. There's something going on. There's a story behind that we can talk about sometime. Yeah. But I'm just saying that's a result. When you look up, because I remember when I started, there were so many things that, I heard Nelson in the beginning, this is an exercise in imagination, reason, logic, and prophecy. I heard the word prophecy, for whatever reason, it stood out to me. Then he talks about the investors' diversified services that his brother got him involved in. He had to pay a premium, not really a premium, but an investment. He didn't have any money. They show him this graphic, this stock market graph, wave of lies is what Nelson was saying. You don't have, if you had $10,000 now, back then, this is what it would turn in today, what it would turn into in the future, but you don't have $10,000, so we'll just start you on this monthly investment program. And you had the initial 7 years in. Right, because that's where the crossover was from your total investment. If it had a whatever rate of return, that's what the value would be. American Express bought IDS. All right, and I sold my mother one of those plans, and it was with Waddell and Reed. I was with Waddell and Reed at the time, and so I'm hearing these things, and they're just like, man. And here I'd been in the life insurance business 14 years. No one had ever mentioned the idea that you could control the banking function. And if you did that, it would, I don't want to say insulate, but it would dramatically de-emphasize the need or the perceived need of some outside investment guru on Wall Street, whatever they promote. I mean, there was a whole lot going on. And that I mean, all of that, my experience, your experience, exposing yourself to this idea and understanding and reading and just interpreting and chewing on, read and chew on and applying Nelson's work, Becoming Your Own Banker, in his second book, Building Your House of Wealth. That is the shortest path to closing the gap. In my opinion, because you can do really good work on technicals of life insurance, and you should. I think I can do really good work on whatever I put my hand to. I don't think that it would necessarily shorten the gap for the broadest amount of people or for the average All-American. It'd be supportive, no question, because, once you close that gap, you look around, you're the dang Lone Ranger. That's why people listen to podcasts like this and why we encourage people to create content and put it, because there's not enough out there and we're all feeling like the Lone Ranger. So other works that are legitimate, not the third party illustrative, manipulated programs to get you to say yes. No, I'm talking about when the gap is closed, right? And your comfort level, your confidence level goes up. It's okay to connect with supportive and understand and read and reread supportive type works and thoughts.
Yeah. I think there's certainly an element of reinforcement.
Yes, right? Absolutely.
Supplemental, reinforcing, just raw, for me, just kind of recreational. Like I just want to know, curious, sure. Satisfying curiosity, but reinforcing, adding conviction and affirmation, none of which is necessary. I get that. But to me, it's like, it's there. It's not been well articulated before. The case for whole life in general has just been bad. We've talked about the characterization by the companies in the 80s during the modified endowment contract hearings, that no case was made from the perspective of the principle of ownership,
not even a weak
of equity,
not even a weak case. Yeah. They didn't even attempt to defend themselves, which makes me believe, leads me to believe that they were in freaking collusion.
Yeah, it was, if you're going to penalize us, grandfather everything else in, and then, let's have a say, have some hand in the setting of the rules going forward.
Yeah, and James, you're just being a conspiracy theorist. It's collusion. There was the greatest wave of demutualization occurred after those hearings. Okay, James, draw the connections for me. Okay, here I'm called before the Senate and I'm a life insurance, executive, and I'm not even defending my product, my industry, the heritage. I'm just going along and acting like a whipping boy for the Congress and comparing or opposed to the Wall Street and the term promoters. Bull hockey. They showed up and they didn't defend themselves. Right? They didn't make an argument for mutuality. They didn't make an argument for private ownership. They made no defense
or even principles of equity accumulation. Right? That is the fundamental. That to me is the core of the argument against the idea of altering, downgrading the tax treatment of a contract because of the way in which equity accumulates, right? Too much, too soon, it means penalty. That's to really tie this back into what we talked about earlier, that is a violation of these, natural law-based, law of equity, law of large numbers type concepts, right? To transgress against the law of equity on the basis of tax principle, right? The nominal accusation being that, people in whole life are going to enjoy this great benefit in cash value growth, and that growth is not interrupted by tax, and people can get to it by policy loan without triggering tax. And all of that is a threat to these conventional assets. Which ones? Well, the government's, of course. How convenient, right? People are going to buy less of the bonds. They're going to buy less of these other products from Wall Street. So we've got to penalize from a tax perspective the whole life policy. and tag that penalization, tie it to cash value growth, equity growth dynamics. Like that is to violate the principle of equity, right? That's what which is horrible. I mean,
they violated their character, their own character.
Yeah, the foundational product of the of a whole industry.
If you're willing to violate your personal your personal ethics, right? Your own character. Well, hell, there's no reason why you wouldn't violate everyone else's, all the policyholders.
Yeah,
and
that's why I come back to part of the reason for that attitude. Yes, there's negligence. Yes, there's just amoral, like practical, do enough to get the job done now type mentality, smooth it over, minimize damage, all that sort of mentality. There's some of that, but there's also ignorance. Like there's also just a lackluster, insufficient characterization or understanding of whole life as property in which you can engineer the growth of financial value, right? It's always been billed as or positioned as a source of permanent death benefit. And it's like, yes, it is that. But what something is technically is different than what something is necessarily, like from a meaningful perspective, like what it means for your economic life. Like a table is, a certain kind of wood, but how you interact with a table has very little to do with, the biological makeup of the wood, right? You regard it not as just a hunk of material, but as something meaningful, as a tool in your own life. Same thing with whole life. You can, it's characterized by permanent death benefit. Okay, but the functional role is different. Like that case still hasn't been made. And, and I think you could follow, like to really pursue that line of thought seriously. I mean, you could then come after, and I maybe one day will, but like the theoretical justification for this idea of maximum insurability, human life value, right? Like that's suspect to me. That should be challenged too. Anyway, that's what I've been thinking about. Technical makeup of whole life.
Mm-hmm. I think that would be helpful. It's to me that none of this happens in a vacuum. Going back to the Senate hearings, attacking whole life insurance, colluding with not only Wall Street and the term promoter, but some of the actual life insurance executives, I believe, were part of that collusion. When you can't defend yourself, you can't defend your clients, you can't defend your existence as an entity, and you can't defend your heritage. There's something wrong.
Yeah, I think they saw it as, I'm just speculating here, I think they saw it as like an appeasement strategy. Like the big companies don't really care, right? Like as long as the policies currently enforced aren't affected, as long as there's nothing retroactive, and you got these guys making a big fuss, and no one wants to be seen as like supporting tax evasion. Mm-hmm. Right? This is what the implication was, that you're dodging taxes, and these big financial firms don't want that reputation and all the
damn near made up out of whole cloth.
Yeah,
you're dodging tax. It's a tax loophole for the rich.
Yeah,
like, shut up.
And they relied on a few, and you can download the exhibits and look at them, but relied on a few, like literally 2 or 3 print advertisements from 1 or 2 companies to support that claim, right? That people were in fact dodging evading taxes. Never mind the fact that like having access to more capital might put you in a position to invest at a greater scale and generate relatively greater income and thereby pay more tax, on genuine new production that would not have come were it not for that systematic capital accumulation in the first place. Never mind all of that, right? That argument, by the way, not ever once made. But I think there's this view of relative ignorance, relative neglect, maybe to some degree moral defect, like should have, why didn't you? That too. But then just a failure, an inability, a lack of understanding of what whole life could mean to someone's economic situation outside of the raw material fact of more death benefit.
Yeah, I like the moral defect. Not to stomp on it, but to me, if you can't defend yourself, your heritage, your product, your clients, and then shortly after that, I said, oh, there's a great wave of demutualization. Oh, in between those Senate hearings and the demutualization was the introduction to these qualified plans, the simple IRAs, and all of these products that make millions and billions of dollars for Wall Street. Oh, a competitor to the life insurance industry. Yeah. And then the no question that let me go to demutualization, and some of these that have happened, relatively in the last few years, one of them out of, I won't go into who they are, but y'all listening that know life insurance know that a Canadian hedge fund, private equity group bought a company out of Ohio, the very old mutual company. They demutualized so this predatory financial construct could purchase them. Just let me, hear me out. Go look at the numbers as much as you can get access to. All of the management at the life insurance companies got paid tremendous bonuses. About a tenth of the value was paid out or assigned to the policyholders. All right, think that one through. It's a mutual company, right? The policy owners are the owners of the company. So I'm just saying the math doesn't add up for me. And there were tremendous windfalls for the people in the management that had a hand in the demutualization of a life insurance company. That occurred as well in the 90s, right? So I think there are some moral defects going on there. Is that what you call it? Moral defect?
Yeah. Maybe a more morally defective part of the argument or, feature of the history.
Of course, there's some ignorance, maybe.
But people are getting paid is your point.
Yeah.
Yeah.
Exactly. All right. So, philosophy does matter. This idea I like what you said, which we all get to when we close this gap, the freedom and independence legitimately in the financial world and the de-stress result of, the result of de-stressing. I don't care what the market does. I don't care what the dollar does. I can't control it anyway. I don't care. Whatever the currency is what they, quote unquote, what they choose it to be.
Yeah. It would be interesting maybe through like a set of Freedom of Information Act requests to get from the Insurance Commission in Ohio the documents pertaining to that demutualization to the extent that you could see where the money went. I would expect that you'd probably be able to see quite a bit. I mean, you can get the entire financial report's like a 250-page document with all sorts of very in-depth financials on these companies from National Association of Insurance Commissioners or from directly, they just get it from the commissions. And the commissions, these are public commissions, everything's subject to Freedom of Information Act rules. So anything that's not like, there's certain very limited restrictions about proprietary information, that type of thing. But as far as just raw data, like what's happened, there's a lot of that. Nobody looks into it, of course. I think there's been literally zero work on that particular demutualization. It'd be interesting to see, because it was private equity plus a pension fund got together, and yeah, that'd be interesting. Yeah.
All right. What else? I had fun.
Yeah. Barbecue time.
Yeah. Thanks for listening.
Bye, y'all.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.